and thank you very much for dialing in today on Friday, the 27th of September. I think we have 3 or 4 days till end of the quarter 3. Within a business, it is important to measure this up, and I think I love this quarterly kind of feeling. It is sunny morning here in Edinburgh, where I am dialing from. I don't know what about you, Adam. Adam, what is the weather like in Southampton?
It's not as sunny as in Edinburgh.
Fantastic. So this is today about all financial aspects of the business, specifically about mortgages. Together with Adam, we run series of webinar to educate ourselves financially as entrepreneurs, as individuals. We need to get a little bit more knowledge about how to best plan your financial future. And it is my pleasure to welcome you, to invite you to the this fantastic webinar. We also have a little bit of warming up. Like, let us know where you're from, what questions you might have. This is the chat. You know how all of this works. Hopefully, we will give you also some of the good buzz, good vibe by the end of this week, starting good Friday, good weekend. So, Adam, please introduce yourself and dive deep into the topic that we had discussion: mortgages for business owners and the self-employed.
Yes, Bartek, thank you very much for giving us a platform today. My name is Adam. I'm a director of Step by Step Financial Solutions. Been involved in mortgages since 2011, so it's been a while now. And one of the most common questions we get is, how do you help people, self-employed people, when they run their own businesses, to get a mortgage? This is a very common question. A lot of our clients are self-employed, are business owners, and we felt that this is the right platform to share the knowledge and ideas about how people can prepare, what they can do to put themselves in the best possible situation, or if they are just thinking about setting up their own business, to let them know how this can affect their affordability and mortgageability moving forward. So we're going to cover some of the common misconceptions as well. And I'm really looking forward into Q&As at the end, if there's going to be any.
Definitely. Let's dive in.
Excellent. So what I'm going to do, guys, is I'm going to share a quick presentation. Okay. There we go. So Bartek, can you just tell me whether the screen, which I'm sharing,
yes, it's nice and clean and crisp. Yes, thank you.
Yes? Okay, that's great. Excellent. So heavy subject for a Friday morning, mortgages for self-employed in 2024. Let's just quickly go through the agenda today. We're going to talk about understanding of eligibility criteria. So how lenders are looking at the self-employed individuals. We're going to look at income assessment. We're going to do a little case study as well. And we're going to finish up with the Q&A. It's always nice to start with the purpose. And I would like to introduce you to the purpose of this webinar today, because our goal is to explain everything about mortgages for self-employed, and we really hope that at the end of the session we'll be able to fully understand all the requirements of how to obtain the mortgage as an individual or self-employed person, and hopefully we'll be able as well to distinguish between the common misconceptions about mortgages for self-employed. An important notice as well, I mean, your home may be repossessed if you don't keep up repayments of your mortgage. That's an obvious one. But this presentation is purely for information only. It's not intended to give any individual financial advice. You always recommended to talk to your accountant or talk to a qualified mortgage advisor to discuss with them your individual circumstances. But what we're going to do today is just try to generically give you some information. But please, if you need any specific financial advice, talk to a specialist first. So I think what we should do now is just address an elephant in the room. Is it easier for employed individual to obtain a mortgage? We always hear that. Is it more difficult as a self-employed person to get a mortgage? Is it really? Let's dive into this subject. What we need to do is just take ourselves for a split second. I know it's not going to be easy, but take ourselves back to the COVID situation and what happened after COVID. Because in fact, the COVID was a huge interruption for not only the business owners, but as well for people who are working for other businesses. And during the COVID-19, lenders were really cautious about approach to lending, especially to self-employed individuals. As a mortgage broker sitting in at home and advising people, I didn't really understand why self-employed people were penalized heavily during the pandemic and after pandemic, because effectively, as a common sense approach, if you are working for a company who's going to go bust, or whether it's your own company who's going to go bust, the result is pretty much the same. So as a mortgage brokers, it was really hard for us to digest why people were penalized a bit more after the COVID, but there were some concerns. And the lenders actually introduced a higher deposit requirement. Some lenders for self-employed individuals. Some lenders were introducing a loan-to-income cap. So the affordability calculator for a lender may actually give you a figure of 200,000 to borrow for an employed person, but an self-employed individual may actually had a cap, which was 4.49, for instance, 4.49 in income for a self-employed, which again, it didn't put a self-employed person in the best possible scenario. So there were interruptions. A lot of lenders, when we talked to them, they were really worried about any type of business support grants, business bounce back loan, business grants. Obviously, a lot of business owners have taken those bounce back loans and grant and all the support from the government. But the lenders are looking at the information which were provided to the government. And the main question on those support grants were, was your business affected? Are you struggling financially? Do you really need that money to keep going? And if answer was yes, then you were eligible for those grants. But the lenders were looking at those informations. Okay, so your business is struggling. We are very worried because you declared that that's the situation. But since then, lenders have actually adjusted a lot. They understand the impact of pandemic a bit more now. So hopefully this COVID-19 pandemic was once in a lifetime situation, and we're not going to go through that again. But as a business interruption, some industries were affected a bit more than others, and lenders are primarily looking at the risk when lending the money. So they evaluate how likely are you to earn the same kind of money in the future. So what's the predictability of your income? When you're employed and you've got your salary, the predictability is quite kind of easy to follow. But when you've got your business, when you've got a support grants, when you've got fluctuations, then the situation is a bit more complicated. But the lenders now are able to look at the 2 or 3 years of trading, and they can actually see where the dip was, and we can explain to the lender why this dip was affected by this pandemic and how we can actually get out of it. So there's a bit of a more flexibility now, and we're pretty much back to normal. But if we put a one in a lifetime scenario out of the equation, how about document requirements? Let's quickly look at that. Because the lenders will use different documents when assessing affordability for employed and for self-employed individuals. If you are an employed person, you are probably likely to be asked for 3 months bank statements and 3 months payslips, maybe even a 1 month payslip. Some lenders may ask for a copy of the contracts if this is a new employment or there are changes within your employment recently. Some may look at employment reference letter even, or ask for P60, normally to assess like additional income. So this is very clear and very transparent. However, for a self-employed individual, you may be asked for a self-assessment, which is a tax calculation document. You need to provide the tax overview along with your tax calculation. For a limited company business owners, you may need to provide a full set of accounts. Or even the lender may ask you to provide an accountant certificate from a qualified accountant to understand your business even more. So we can already see that there are slightly different requirements for self-employed individuals than for employed people. And that seems more excessive than just providing a payslip and bank statement. But let's think about who actually is classified as a self-employed person and who is employed in terms of lender's assessments. So who is actually self-employed as far as the mortgage purposes goes? So any individual who is a sole trader will be classified as a self-employed person. Anyone within a partnership, or anyone within any partner within a limited liability partnership, or a limited company director or shareholder with more than 25, normally more than 25% shareholding within the business. So if you are a business owner with more than 25% shares within the business, you may receive a pay slip, you will still be classified as self-employed individual. Even if you own a part of the business jointly, let's say with your other half, and you both have, let's say, 15% each stakeholder shares in this business, you may still be qualified as a self-employed. Even if you are actually employed by a limited company, but you receive a salary and dividends as your remuneration package, you may still be classified as self-employed. So this is very important when contacting your mortgage broker to make sure that your situation is assessed correctly and that you actually understand what sort of documents you may need to provide at the point of mortgage application. So why this is so important? Let me tell you a story about Chris. Chris is a director of the window cleaning company. We hope that Chris is going to have a long career despite his current position and the height he works on. So Chris is thinking about getting a mortgage. Obviously, he wants to get ready for that. He wants to make sure that he's fully prepared and he's able to take advantage of all his income and get a mortgage which he needs to buy a house he desires. So let's look at Chris' financial profile for a second. Chris has over 3 years trading history as a sole director of the business. So he's got 100% share within his business. Chris at the moment pays himself a salary of £1,000 a month. This probably sounds familiar to a lot of business owners. He draws as well a modest dividends at the end of the year, of about, let's say, £5,000. Chris have heard an interesting information that as he's receiving a payslip as a PAYE employee of his business, he needs to provide a 3-month payslip to obtain a mortgage. So what does he do? He actually contacts his accountant and asks an accountant to give himself a pay rise. Suddenly, Chris has got a pay rise and his monthly payslip is now £3,000 per month, which is totaling £36,000 of an annual income plus his dividends. After 3 months, Chris is highly confident that his position to get a mortgage is totally different now because he's making much more on a yearly basis. Easy, or is he not really helping himself? Let's go back to the information from the shareholder standpoint. As a shareholder of more than 25% of his business, he will be classified not as a PAYE employee, but as a business owner. So lender in that scenario is looking at the whole business and assessing the business as a whole. So lender now is likely to look at the whole year salary and dividends, possibly average, depending on lender. And they will be looking at the profit possibly as well from this business to make sure that he can afford to pay himself a new salary. So effectively, when we are looking at his income, it's not his pay slips as a more than 25% shareholder, but his overall situation of his business, because he is a business. Business is Chris and Chris is a business, although from the legal standpoint, they're two different entities. So we need to always remember that. So why do we generally think that getting a mortgage as a self-employed individual is just more difficult? Is it because the PAYE income is taken as an income by the lender before tax? So we all know that if we have a salary of 36,000 per annum and we have an equivalent of 3,000 gross income, the net pay will not be 3,000. There's going to be some deductions, right? There's going to be national insurance, contribution, tax, and so on. But the lender is looking to take the full salary before tax. This is actually exactly the same for a self-employed individual. If you declare a net profit of 36,000, that's exactly the same income. But self-employed individual can actually deduct numerous business-related costs, which can actually significantly affect the amount of tax they pay. And if anyone loves to pay more tax, they can actually raise their hand now. I'm pretty sure there's not going to be anyone here who's going to participate. But if you lower your net profit figure by introducing tax-deductible expenses, your profit will be actually lower, which means that the income you've declared is lower because you've actually deducted the cost of getting the business. So anything to do with running your home office, for instance, someone who's actually employed and still works from home will not be able to make any deductions. His situation is less flexible. He's got this £36,000 per annum, and he cannot adjust that by any stretch. He can work more, but he cannot reduce his tax liability. The same applies to his phone bill. The same applies to his car costs and so on and so forth. So we need to be careful with that. However, what I would like to point to is that, let's say 50,000 PAYE income as an employed individual is actually equaled £50,000 of the net profit as a sole trader. And this is the same 50,000 can be combined from a salary of 20,000 and dividends of the 30,000 as a limited company director. This is still £50,000 income. Or if you don't draw dividends, you may have a salary of 20,000 and net profit of 30,000 within your business. That's still a 50,000 worth of income. So I think this is really key, and it's essential to understand that from the income standpoint, the income is an income. The lender will take a multiple of our income when assessing the situation. However, there are different document requirements, and the history of the business may be as well taken apart. So it's not only a payslip to provide and a bank statement, but there may be more documents to provide. It's just purely because the lender would like to understand how you run your business and what's the risk associated with lending you money. So what will be quite interesting as well is to look at the documents. We know that we've got a slightly different document requirement for a self-employed individual. So let's look at a tax calculation document. Tax calculation is very important to a lender. Let's look at what actually is within this document, because that will again give you some more information about how lender may look at your income. So when you're generating a tax calculation, you can either do it yourself or you can ask your accountant. There are certain information included, like your surname, your unique tax reference number, your tax return completion progress. make sure that when you got this document, it is 100% completed. Because when your tax calculation document provided to, let's say, a lender or a mortgage broker is only 90% completed, it's not going to be valid. It just hasn't been submitted and can be adjusted. So lenders would expect you to have a fully submitted 100% completed tax calculation. And what's quite interesting is that what sort of income will be shown on this document. And the basic answer and the easiest answer is all type of income which are pretty much taxable. So you may see that there is a employed income. So that's going to be a salary, whether you're employed or self-employed limited company director. You may receive a PAYE income in the form of a salary. So it's going to be employed income. Self-employed income, that will be income which is a net profit figure from our sole trader accounts or partnership. That's going to be self-employed income. There may be a dividend income if we pay ourselves dividends out of the profit at the end of the tax year. That's going to be declared, and you can actually see that on this document. Any income from land and properties. So that's any landlord who is declaring an income to a HMRC for letting his property out. The income from land and properties will be declared on this document. Any interest from UK banks or even foreign income. So all the income which is pretty much taxable, you will be able to see on a tax calculation document. What's quite important and where we see a lot of delays with lenders making a decision is where you can actually see there's a page 1 of 2. There may be a second page. It's really important to download both pages. A lot of times the second page, there's pretty much nothing on it, but you still have to attach 2 pages because that's the full document. That's how picky the lenders are. But knowing that, we can deliver the document once, and it's going to be less time waste for you guys. Along the tax calculation, there is a tax overview document. Tax overview just shows your tax liability and whether your tax been paid. So that's how the tax calculation, the tax overview document may look like. And actually, for the lender tax calculation, tax overview, they just take it as a one document because the tax calculation will show your tax liability, and this will show how much exactly you have to pay and whether it's been paid. So lender would like to see whether those figures are actually correctly matching, whether the tax declared and tax on tax overview is the same. If it's not, then the lender may ask a further question. Again, all pages must be included. You're going to get information about your surname, your tax year, your tax liability, and those 2 documents goes together. Another document which may be required for a limited company director is a full set of accounts. Not every lender will ask for it, but some lenders may, and that's it depends on income they're going to be using. And I will quickly explain you what's included in a full set of accounts. You're going to get an income statement, balance and sheet, so like an assets versus liabilities for the business, profit and loss, detailed balance sheet with a bit of more information. But one of the most important information which you can find is on the income statement, where you can actually see the turnover of the business, you can see the operating costs, you can see the tax, and you can see the profits of the business after tax. And some limited company directors may have a so-called retained profit figure. So they may actually draw a salary, plus they may take the dividends, but dividend is taken out from the profits. So if you have a large profit, you may not decide to take a lot of dividends from your company. So you may decide, I'm just going to take, like in this instance, this business have a 59,000 profit, but you as a business owner may decide, I'm only going to take 20,000 out of this business. The rest I would like to keep within the business as a retained profit. I did pay my corporation tax on that money, but I don't want to draw it personally to have this listed on my tax calculation and be taxed on it again. So I'm just going to keep that funds within my business and maybe reinvest it in something in the future. There are lenders out there who can actually look at your salary and your net profit figure, even gross profit. It is only probably one or two lenders which can do that, but even profit before tax can be taken if you don't take the dividend. So there are different ways of calculating an income, and now it depends on your appetite for borrowing the money. Profit and loss account will show you the amount of salary you are paying yourself. So there should be a director's salary and cost or director's remuneration figure. That will show you how much money you've actually paid yourself within the tax year. Why this is important? This is important because your company tax year may not be aligned with a tax year as a general. Normally the tax year is from April to April, right? That's how you run your self-employed assessment, from April to April, but your company may be registered in July and your company accounts will be from July till July. So again, if your company year is not in line with the tax year, it may be beneficial to provide full documents to a mortgage broker, to the company like ours, because then we can look at what's been declared within the tax year on the tax calculation form and what is actually declared on the company's accounts as a salary and profit figure, because it may be different. And in that situation, we can actually look at those two documents and say, okay, this is more beneficial. If you are looking to borrow more money, you're looking at this type of house, this type of mortgage, that income will be more beneficial for you. So it's nice to get a full list of documents. So how to get these documents? Because a lot of times you may struggle to actually obtain those documents. You may not be looking at those documents on a regular basis. You may have a email from your accountant saying, this is your tax liability, this is how much you paid yourself, thank you very much. In some way, when you're getting a mortgage, it's really nice to dive into these figures. You can actually request those documents from your accountant. Or you can ask the mortgage broker to help dealing with this. Like, for instance, when clients comes to us, we are more than happy to get in touch with an accountant and say, hey, we know exactly what we need. We know that the accountant may have those information. Let us deal with this. Not a problem at all. Obviously, when client gives us the authority and gives the authority to the accountant. Or if you want to do it yourself, you can actually download it from the website. At Step by Step Financial Solutions, we've got a range of useful guides for our clients when they are looking to download those information themselves. So how to do it is it's relatively easy. All you need to do if you want to download it, and you can actually, whether you are employed, self-employed, or you are a landlord, you will have your tax calculation. Even if it only shows income from employment, you will have your tax calculation because that shows your tax liability for the year, for the tax year. All you need to do is just go to the HMRC website, you sign in or you register. Upon registration, you will receive your government gateway ID. You create your password and you're logging into the account. So what you need to do, you need to find more information about self-assessment return. Just click on that. Where you're going to go from there is get your SA 302, which is a tax calculation. Then you will be directed to continue to your SA 302 page, and then you can download it. And underneath that, you're going to have view previous year's self-assessment. So you can then download, let's say, 2 or 3 years at the same time and save them on your laptop. And again, make sure that you save the full documents with 2 pages. That's really important. The same applies to your tax overview. Just underneath the tax calculation SA 302, you've got view your tax year overview. Again, you click on it, you follow the same steps, get all this, let's say, latest 3 years downloaded, and then you can package everything and send it to your mortgage broker. And you're done. or you can save it and look at the document yourself before. So let's see at the most common question we're getting, because that's always, we get a load of inquiries within Step-by-Step Financial Solutions, and a lot of them are exactly the same inquiries, but they very valid inquiries. These are things which affect a lot of business owners. So let's quickly look at just a few most common questions. The first one, are liabilities reducing the affordability, the ability to get a mortgage? So what if you take a personal loan or business loan? Is that having any impact on the amount you can borrow? The answer is yes. So any type of liability which is taken by a business, so in limited company name, will actually reduce the profit figure, because the cost of financing is likely to be included in the expense sections, which means that you're going to get a lower profit. So that's already having an impact on the ability for you to get a mortgage. But as a sole trader, you normally would have the loan registered under your personal name. And it will actually show you on your credit commitment. So you may be actually penalized twice as a self-employed individual, because you may have taken a loan for a van, which you use for business purposes, which means that the cost of financing the van will be tax-deductible expense in some way on your tax calculation, right? So you're going to get a lower net profit. But at the same time, the same loan is actually registered against your own personal name, which means that your credit report will pick up a, let's say, 300 or 400 pounds loan as your personal expense. And that again is nearly 5,000 pounds a month expense that will surely have an impact on your ability to get a mortgage. So is there any way out of this? Possibly. And it very much depends on the lender and your circumstances. But we have seen many times, because we work really closely with the people from construction industries, where a lender is able to take a view on the things like, let's say, a van finance. So if you are a sole trader and you've got a van finance which you've recently taken and it's purely for business purposes, there is a way of approaching a lender with relevant information from your accountant, who is able to confirm that this was for business purposes and is already kind of included within your tax calculation. And lender may actually take a view on it and not use it as your personal expense, which can tremendously help you out with getting a right mortgage. But that's obviously subject to full underwriting and lender decision. But there is a way around this, and we have seen the clients increasing their mortgageability tremendously after really diving into those business expenses. So how long do you need to be registered as a self-employed individual to get a mortgage? This is another big question. Normally, lenders are looking at the latest 2 years. So they would like you to be registered as self-employed or limited company for the 2 years before they can consider the mortgage application. Again, they are really looking at sustainability of your business. So they would like to see a bit of a consistency. They would like to see that your business is trading in the right direction before lending you the money for the next 25, 30 or 35 years. However, some lenders are able to consider just 1 year accounts. So even if you've got a 1 year history of trading, you've got a 1 full year, you can actually already approach the lender and get a mortgage. Again, subject to full underwriting. But you don't need to be self-employed for 3 years, which is again common misconception. What if you switch from self-employment to limited company? Again, very common scenario, especially when we see clients doing this for tax purposes. You can actually switch from being a self-employed sole trader to a limited company and still qualified for mortgage. However, a lender may typically want to see the full trading year of your limited company. They will also assess your salary and your dividends at the end of that year. Plus, they will take the net profit from the previous year, likely to take the average and go from there. Some lenders, or a majority of the lenders, really don't like the changes within the ownership when you do that. So when you are a 100% business owner as a sole trader and you move into a limited company for tax purposes, when there is a change in ownership, so let's say when you decide to add your other half as a 50% shareholder within the business, so she can be actually eligible to receive dividends. A lot of people will do that to avoid hitting any high rate tax bracket, for instance, because you can split the difference. You don't need to declare 60,000. You can actually split the difference with your other. Lender may need to see the full year or even 2 years. But if there's no change of ownership, there are ways of looking at just 1 year. Even there is a situation and there is a lender who may look at your self-employed income with the help of an accountant certificate and certain projection, even if you don't have a full year completed as a sole trade, as a limited company director. So a lot of flexibility here. That's another one. What if there is a large increase in my self-employed income? So if I was self-employed for 3 or 4 years and I've always declared about 15,000-20,000 of the net profit, and now suddenly I want to get a mortgage and I'm declaring 40 or 45,000, how is lender likely to look at our situation? Is it acceptable? Can we take advantage of that? The answer is, again, it depends. There are lenders which may still look at your latest year, at this 40 or 45,000 pounds, even though in the previous years you were not showing as much profit. But they will be looking at your situation and they will try to apply a common sense. Again, is this a trend or is it just a one-off great year? So they may ask your accountant again for projection. They may look at your turnover. They may actually look at the reasons why. So you may actually say that, or some clients have made a significant investments in the previous years, which reduced their tax liability and their profit. But this year they full steam ahead. They don't have those large liabilities. They've taken some people on board. They're able to take the new projects, new clients. And if you are able to explain to the lender how you actually achieved the growth, there are lenders who are able to look at your situation individually and say, we feel comfortable with that. Let's go with the latest year. Some lenders will still take the average. So now it depends on your ability or your appetite for borrowing, wherever the situation goes. When should you talk to the mortgage broker? Is it before you go and submit your tax return, or is it after you've got all your documents ready and you're fully prepared, and then you should go to talk to the mortgage broker? And again, it depends. Your declared income should always reflect your accurate earnings, because you are taking a debt which you will need to repay. And if you declare inflated income, you may not be able to afford to pay that mortgage in the future. Because what the lender do, they apply a buffer. So they will always like to stress rate the mortgage. So what if the interest rate goes up? Can this client still afford this mortgage? And so on and so forth. That's why you may feel like the mortgage which you are getting is not sufficient because the monthly mortgage payment may be below what you are willing to pay. But lender is always kind of looking at the risky side and increasing the percentage to a few base points to make sure that you can still afford this, even if the interest rate goes up or your mortgage goes down ever so slightly. So in some situations, it's worth talking to a broker months before you're looking to submit your tax returns and work on your company accounts. Why is that? You may have an idea about a large investment within your business, like maybe changing the van. But you at the same time are looking to maximize your ability to get a mortgage. So what can actually happen is you may, after talking to mortgage broker, you may defer that investment for a few years. You may say, well, maybe I can still keep up with this older van, get it repaired. But if I take the large loan right now, I'm going to reduce my profits. I'm not going to have enough income to get a mortgage. So it is always worth to talk to an individual as soon as possible, because if you know the all the variables which you need to know, and you know what sort of property you want to buy, being self-employed, the beauty of being self-employed is that you got a more flexibility. When an employed person would like to increase their income, they may work in overtime. So those overtimes may not always be available. But if you are a self-employed individual, you can always try to work harder. You can always do extra hours. You can always do some additional marketing. You can always do some extra quotes. You can always try to revisit some old clients and so on and so forth. So if you want to kind of be more lender worthy and get more money from the lender, it is worth talking to a broker, because they can actually prepare you for a smooth ride at the end of the process to make sure that you hit all the right boxes for the lender. But again, we're not talking about inflating your income. We're just talking about working hard to achieve your financial goals in a sustainable way. How about employing a spouse? Yes, this is a big area for lenders, and a lot of lenders see a lot of fraud in this particular area, where you're just employing someone for mortgage purposes with a high salary for 3 months to provide lender with a sufficient income. So lender knows that. They know this. So they are likely to be very careful with that type of application. It's not impossible and it's not uncommon. We can actually employ family within our business. Absolutely fine. But what we need to make sure is that we don't give any like a massive pay rise before that, because that's just looks dodgy. It may not be. This person may actually deserve a salary because they were part-time, now they're full-time. The kid went through school, so there's more time within the business. So again, there are ways of explaining this, but it needs to make sense. It needs to make common sense, because someone who's going to be checking your application, they don't know you. They can only rely on the information they see. And they see certain trends within second jobs and employing family members, where people are really pushing the boundaries. So how lender can actually behave in that situation? They may request a 6 months bank statements and pay slips. They may not take, let's say, recent pay rise. They may take the pay before the pay rise. And they may look really closely into your profit and loss account to make sure that your business can actually afford to pay that salary in the future. So nothing wrong, but just make sure, apply common sense. So what should you do to actually increase your chances of getting a mortgage as a sole trader, self-employed person? A lot of similarities with any type of mortgage. Just make sure you maintain your credit file in the right order. Pay everything on time. Manage your financial commitments. Don't overstretch on the credit cards. If you've got a balance, don't use over 75% of your credit card limit. And repay it regularly, in full, ideally. That's actually boosting your credit score. Good bank account conduct. No gambling. Lenders hate that sort of stuff. Whether you're employed or self-employed, they are looking really carefully. Even the small amounts, they don't really like. Look at your spending habits. Analyze or talk to a mortgage broker. Call Step by Step Financial Solutions. Send us the bank statement. We can always look at this bank statements and give you some feedback about what we know the lenders like and what they don't like, and how you should actually try to manage your bank account conduct. Sufficient level of turnover on your business bank statement. That's another one. If you are looking to suddenly declare £40,000 net profit with a turnover of 45,000 and business which is likely to have a lot of expenses, that's not going to make sense to a lender. So if you are looking to declare a significant amount of money, there needs to be a turnover figure which supports this. So there needs to be money coming into your business account, whether it's a limited company account or your sole trader account. Lender would like to see, how did you come to this income? Where is your income coming from? Again, talk to the mortgage broker and accountant before. Prepare yourself far in advance. Having a deposit, sustainable deposit or substantial deposit actually always helps, because the more deposit you've got, the less risk there is for a lender, and there's a more chance for you to be accepted. Come to talk to us. I hope over the last 35, 40 minutes, I've earned the right just to give you a quick sales pitch. Why you should contact Step by Step Financial Solutions. I mean, don't take my word for it. Just go to our Google profile, either Southampton, Bournemouth, London listing. We've got over 400 Google 5-star Google reviews on those profiles, nearly another 100 on the Facebook. So nearly 500 5-star Google reviews with 8 fully qualified and experienced mortgage brokers with an amazing admin team, which can give you update at any time, and very transparent pricing. Guys, we are very transparent with our pricing. You know what you pay for, you know when you pay for it, you know how much you pay for purchase, buy-to-let purchase, remortgage, buy-to-let remortgage. We'll give you these figures up front. They are here for you to take the notes. We feel that they are competitive, providing the service you're getting from Step by Step Financial Solutions and all the additional stuff we always try to do for the clients. And the product transfer, if you've got a mortgage and the best thing for you is to stay with your current lender, we will help you choose the best deal from that lender, and you don't pay a penny. So we always want to add the value to our services. So come talk to us. Thank you very much. And I think, Bart, we are open to any questions.
Definitely. First of all, thank you for taking this into so much details, because I think we, as a business owner, we never realize about how all of this works from the perspective of lenders. Yes, we know we've got more money, but doesn't mean actually we get this money to get this mortgage. Excellent presentation. We definitely will share this recording to, to others. We have a Gernam question. Official documents that that a business has the payslip and YE returns. What do we show a lender? That's the question from Gernam. I don't think she's yet on a call, but that was the question asked.
Can you just repeat that question, please?
Official documents that a business has are the payslip and YE returns. What do we show a lender?
So as a business owner employed by the business, you normally are looking at tax calculation, tax overview, because that shows your income from employment. Or if you are a business owner, you may need to provide a full set of accounts. If you're self-employed, normally is tax calculation and tax overview. That shows your profit, net profit. But when you're business owner, you may be asked for tax calculation, tax overview, because again, we remember from the presentation, you may have a dividend figure there declared for the year, income from employment, or any self-employed. Some people are employed and self-employed at the same time, right? There's nothing wrong with that. All the income will show on the tax calculation. So your payslip are only pretty much relevant when you are an employed and you don't have more than 25% shares within the business. Then the lender will ask for payslips, P60, contract, whatever case may be. But for limited company directors, yes, the lender would like to see that there is a salary going into the bank account. They will check the conduct, but they are more concerned with an annual figure. So how much did you pay yourself within a full year? I'm not sure whether that answered the question.
Yes, Gernam, just if you want to admit, feel free. So the comment is these documents have deducted the expenditure and then tax. I'm not entirely sure what exactly the question is, but maybe you can just unmute. We're not biting, and it'd be great to see your voice.
Sure. Hi, everyone. How are you?
Hi, Gurnam. Hi, thank you for a question.
No worries, Adam. So what I'm saying is, you said earlier on in your presentation, which was a great presentation, quite complex, this stuff, right?
Thank you very much. Really appreciate your comments.
No, absolutely. So my question is, so you were saying that you can take the total income without deductions as a calculation. Because obviously every business wants to operate by deducting by being tax efficient. Let's use the right terminology here.
That's right. Yes.
But then if we can show a total income without deductions as a way of calculating the mortgage, all our official documents are going to be shown after deducting all our overhead, tax and expenses. So that's what I meant by which document are we showing. Thank you.
I get it. So in one of the first slides, I was trying to explain that the lender will take your income when you're employed or whether you're a self-employed director without any tax deduction or national insurance deduction. So lender will take not a net figure, but the gross figure. But we need to distinguish the difference between the turnover and the profit. So unfortunately, lender will never take the turnover because the turnover will show what money are coming into your business. So you may have a turnover. Let's say we've got a client, a big construction firm. They've got a turnover of over £1 million a year. However, they've got a lot of costs, which are normally a subcontractor cost, which may account to £800,000 a year. So their profit after any additional costs may be 120,000. So the 120,000 is a profit which lender will take. However, that's not what the director will take, because the director will have to pay likely 40% tax on that. They will have to pay national insurance contribution and so on and so forth. So the lender will use the profit before taxation or after corporation tax, but before the personal tax is deducted. So there's again difference between the corporation tax on the profit, and there's a difference between the tax which we pay ourselves, and that's going to actually show exactly on your tax calculation, because the corporation tax, that's a different type of tax, and that will you know exactly there's a, let's say it's 20% out of your profit, and it will show in your tax on your full set of accounts.
Great. I'm glad you know what you're talking about. Thank you, Adam. Thank you.
Thank you very much. Any more questions, give us a shout.
Thank you.
Another question we have another question from Nicholas. Can you please say some words about the LTD buying a property? In other words, a LTD applies for a company mortgage, not an individual. I think this is called a SPV for a company owning a property that it rents.
Yes, great question. Thank you very much. I was really hoping for that question, because a lot of investors these days will actually use these vehicles, the special purpose vehicles, the SPVs, as a form of buying a property. Why would they do that? They will do that purely because there are more tax advantages in terms of deducting any type of cost of financing. There are some disadvantages as well, but mainly people do that because they feel that they can have a better kind of cash flow, and they can deduct the cost of mortgage. So what some companies are doing, they keep the profit within the main business. So if you've got if you've got a Chris, right, who's a window cleaner, and he's got this retained profit within his business, just remember, he only took a £5,000 dividends from his company. He may have a large profit within the business. If Chris decides to draw the money out of the business, let's say another 40,000, and buy a property in his own name, he's likely to pay quite a lot of tax personally on that money. But if you've got a special purpose vehicle and you talk to your accountant about it, because I'm not an accountant, I just need to say that, but some people, what they do is they will use a intercompany loan, which they can lend to a different company, and that company's got the funds now to actually acquire a property. So the structure of buying the properties within the limited company is very popular these days. This company only needs to be set up for a few days, so you don't need any trading history on a special purpose vehicle. You can set it up before you buy, you receive your certificate of incorporation, and off you go. But what you need to remember is that company to have a certain and very specific SIC codes. And those codes needs to be related to any property dealing and property trading.
Brilliant. Brilliant. Thank you very much. Any more questions, Nicholas? Yes, definitely reach out to Adam. Maybe you can show the screen with your details or even post on a chat. We definitely will reach out to you to book meetings. What I would say is that 2025 is coming. We're definitely going to be updating you more on what is coming, because rates are now going a little bit down. There are different opinions about, obviously, what does it mean for people, but in general rules, the mortgage might be more affordable for someone who's planning something. So this is something we definitely want to touch and plan 2025, although it's still far before Christmas, but it's great to plan everything ahead. Yes, and please reach out to Adam for a one-to-one. Everyone's single circumstances are different and requires a little bit different attention. But that guide was fantastic overview what to do and how to do in order to make it right. And that presentation will be soon available on our social media channels.
Yes, thank you very much, everyone. There is a no obligation policy within our company. So even if you've got a question about something which you are considering, just give us a ring. Just give us a ring. You can find our details at www.sbsfinance.co.uk, or just Google Step-by-Step Financial Solutions and check our Google reviews before contacting. Because I'm pretty sure you're going to be amazed what other customers got to say about us.
Thank you very much, everyone. Enjoy your weekend, your sunny weekend, one of not many left in this year in the UK. And thank you for your attention. See you next time.
Thank you very much. Have a great Friday.